All right. My name is Chris Campbell. I'm a practicing CPA and I work with small businesses and individuals to help them pay the least amount of taxes possible while keeping them out of jail. So today I wanted to try something a little bit different. Going to do a tax guide for specific professions. And today's tax guide is for locum tenens, doctors, or health professionals. So there are some practitioners, nurse practitioners, but the common thread being here is that you're a health professional that's paid as a contractor and you're not paid with a W-2. With that, as you know, it comes with its own set of challenges. You obviously have to account for your own taxes and pay your own taxes. And there's a couple of other issues. So I want to address those here. So if this happens to be you, these are all the things that you need to account for when doing your taxes, accounting for certain write-offs, expenses, things that you may want to do, things that you can do to reduce your tax liability and to make sure that you are operating optimally. So, locum tenens. With that, you are, as I mentioned, a contractor. You get paid as a 1099 and not a W-2. So, with that, you know that you have to report your own taxes. So the first thing that you're going to do, especially if you're a doctor and you're in this situation, the first thing that you're going to want to do is you want to create your entity, with your entity being that it's probably really just going to be you as a part of this entity. You're not really going to have employees or anything like that. Maybe you may bring along someone to do some admin, but I'm going under the assumption that this is really a situation where it's just you practicing your craft. But you do need to set up an entity to do that, preferably an LLC. But I do know in some states, in order to do that, I think California is one, but I think in some states, I don't even think they let you do an LLC to practice certain fields. And I think medicine is one of them. So you want to create your entity. And if you can do the LLC, do the LLC. If you have to do the corporation route, which I think is the case in California, then you go ahead and create the corporation route. Once you have your LLC, you're going to want to make the S corporation election. And the reason why you want to do that is because you're going to save yourself a ton of money on taxes, mainly the self-employment tax. That's the key or big advantage of being an S corp. You might have heard about it before, but the reason why you want to go and be an S corp is to save on the self-employment tax. Now, with that, you also have to set yourself up on payroll. Once you set yourself as a corporation, now keep in mind, you're still an LLC. You're letting the IRS and the state know that even though I'm an LLC, I'm choosing to be taxed as this S corporation. So I really like going that route. Takes a lot of the complexities out of having a corporation that you don't have to deal with, being that you are still LLC, but you still get the benefits of being taxed as a S corporation. Now you can go and actually file an S corporation proper, but again, I really like going this route because it takes a lot of complexities out. And if we are assuming that it's really just you operating, no need to have a lot of complexity with boards and then into things like that. So that's why I prefer going the route of just having an LLC and making the election, but choosing to be taxed as an S corporation. So now, with that said, once you become a corporation or choose to be viewed as a corporation, your company is now a separate entity from you. So with that said, you need to put yourself on payroll as an office. As a regular LLC, you can just pull money as you need it. Once you're a corporation, you have to set some sort of salary. Now, what you're going to do though is you don't want to max out your salary. You don't want to take everything as salary. You want to take a nominal amount and have that as your salary, and anything that you need beyond that salary, you would take as the distribution. Now, the IRS states that you must have a reasonable compensation for the role that you're doing, but there is no hard and fast rule as far as how much that compensation would or should be. My rule of thumb is I generally go with, say, a third. So if you plan on using $300,000 for yourself, and I would a third of that salary, so 100K in salary, and then I would take the remaining as a distribution. So look at the remaining 200K as a distribution. So you would actually just pull the 200 out straight, and then the other 100,000 would be ran as salary. But you're going to want to set up a payroll as far as with the salary. I would advise don't really try to do the salary thing yourself. There are payroll companies out there. A favorite of mine is Gusto. They make it very easy, relatively inexpensive. You're probably going to pay about $600-700 a year, and they can just have it on auto pay. So if we're going back to our example, pay yourself $100,000 to set this up, and it can go on auto pay. So it will do the direct deposit for you. It'll create your W-2s. It'll withhold all the taxes and submit all the payroll taxes, as well as the payroll tax returns that need to be done every quarter. So for the $600 or $700 that you're going to pay a payroll company to do, they provide just so much value, and also just I'll take a lot of administrative work off your plate. All you really have to do is just take the time, set it up once, get your account approved. That may take about a day or so to do, but the money and the time that you're going to save on the back end as far as the administrative work will be well worth it. So go ahead and set yourself a payroll company and get that going. The other thing that you're going to want to do is now that you're a corporation, you really got to have a set of books. Go get yourself some bookkeeping software. You may be too busy to actually try to do the book yourself. You can, if you're that type of person, but get yourself a bookkeeper. That is a service that my firm provides. But whether that be with me or anyone else, you want to go ahead and get yourself a bookkeeper, have those books on board, because even though it's just you, it is very difficult to put together a corporation return without a set of books. If the industry leader is QuickBooks, usually it'll cost you about $60 a month or so. So you're probably looking at another $600-700 a year. There is another option named Zero, which is a bit cheaper. They're about $15 a month. They're probably the next closest competitor to a QuickBooks, and their product is pretty good. It's a little less user-friendly, if you ask me, but if you're getting someone that's experienced with run books, just have them do it. You may wind up spinning your wheels a lot. And then on top of that, you may get it wrong, and then you got to pay to get it cleaned up. And so I would say just get someone on board to do the books, have the software. Now, insurance. So you're going to want to make sure that you have malpractice insurance, run that through the company, have your company be insured, have you be insured. Those are the main things that you'll have to set up. Now, some of the biggest write-offs that you can take and deduct against all of this 1099 income. Well, one will be your salary, right? So that will be a deduction against the company's income, but your salary is getting paid to you. So it's really just moving from one bucket to the next. That salary part won't necessarily save you any money, but the biggest things we can talk about is travel. I know with Locum Tenens, many times you take assignments and they're not necessarily nearby you. I know that I have some clients that travel pretty far with some pretty remote areas or places where it's tough to get skilled medical professionals. So they're out pretty far, but they pay well. With that, it does require a good amount of travel. So all of that travel will be deductible. So if you're traveling afar, however method that you took to get there, plane, train, automobile, lodging during that time, if you're responsible for covering your lodging. So now I know with some assignments they cover lodging. So if they cover lodging, then you don't have to worry about making that's not running out of pocket. So that would be a deduction for you. But if you are responsible for obtaining your own lodging and housing during your assignments, that's all deductible. Meals while you're on assignment. So now the meals are just 50% deductible, but nonetheless, the meals that you have while on assignment would all deductible. Now, some of the biggest deductions will be your automobile to travel. And we also want to get in there some home office expenses. So ultimately where you live, I'm sure have to take care of administrative stuff, right? So we get contracts, deal with paperwork. There are some administrative things that you do to operate your business. So, because you're more than likely traveling around and you don't have a set place of work, your home is now where you do your administrative work. And I'm sure part of that is an office. Now, that you are a corporation, the home office deduction is not readily available to you as it traditionally is. So the way that you do it is create yourself what's called an accountable plan. And with that, as the head of your company, as the president of your corporation, you are creating a policy for your corporation that will reimburse its employees, which is also yourself, which will reimburse employees for use of their personal assets for business purposes. So, which in this case would your home. So you are an officer of your company, but your home is more than likely your personal name, not the company. Because your company is a different entity from you personally, your entity is using your home as its office. So therefore, they must pay for that. Your company must pay. And with this accountable plan, you can have it set up such that your company will reimburse you for the use of your home. Now, the beautiful thing about that is, as they're reimbursing you for your home, it's a deduction for the company and obviously a deduction for you, but it's not necessarily taxable income to you as the employee. So, for example, let's say that you're working out of home and you decide in your plan that your company needs to pay $1,000 a month for office space, which also happens to be the owner's home. So with that, that would then turn into at $1,000 a month over the course of the year would be a $12,000 deduction. That, and again, and it's a reimbursement. So you as the owner would draw that money from the company to reimburse yourself for paying that housing expense. And that 12,000 is not taxable to you, and it becomes a deduction for the, so in essence, that's the way that you take your deduction for your home office. Same thing with the auto. So if you need to use your auto to get to assignments, but you're going on assignments as an employee of your corporation. So your corporation must pay you for the use of your vehicle. Be pretty indiscriminate about how much that you're going to pay for use of your vehicle. That's another $1,000 a month for use of your vehicle. So that's another way that you can make deductions count for use of your personal assets in your business. So those are going to be two big deductions, right? Your home office and then your auto. So travel is another big one. Use of your phone. I'm sure you use your phone in business. You want to write off a portion of your phone bill. So maybe not the whole thing, because I'm sure you use your phone for personal as well. As long as you come up with a reasonable business use percentage, take a percentage and deduct that. Any professional development, any conferences that you may go to, that will all be deductible. Licensing, right? You have to maintain your license. So any licensing fees that you'll have to pay to practice in the States, or organizations that you may belong to, professional organizations. So those are all things that you can deduct, and you'll put this all against your S corporation income. Any supplies that you may need, any clothing specifically for use in your practice would be deductible. So if you have to buy scrubs, you have to buy the medical jacket. It has to be very specific for the use of that particular profession. Regular clothes that you may wear out and about, that doesn't count, but things that are specific to medical setting would be considered a deductible clothing expense. So keep that in mind. Your medical coats, your scrubs, any safety supplies that you wear, your gloves, your glasses, or anything like that, safety glasses that you may wear. So that's another big deduction for you. And then lastly, retirement. Now, the best thing you probably do here is to, and this is assuming that it is just you, a solo 401. Now, it's exactly as I said, it's exactly as it sounds, solo, meaning that there's only one employee. So with this, the solo 401k only applies if it's one employee. If you have another employee, so if you have someone that's on as admin, then you can't do the solo 401k anymore because now you have other employees. So the solo 401k gives you a lot of flexibility, rules on what you can contribute. So they make it quite easy, but those rules change once you actually have another employee. It has to be employees, so not necessarily a contractor. But assuming that you're in this practice by yourself, and again, it's your services, solo 401k would work great for you. The beautiful thing here is that you can contribute as an employee, so you can take your salary and reduce your salary. So let's say that your salary is 50,000 and you can contribute up to the limit. I think it goes up every year. So as of 24, 24,000 or something like that. You can take a salary of say 50,000, take 24,000 of that, put that in the 401k, and then you'd only be responsible for the other 26,000 dollars. And you can kind of play with that. So let's say that you want to give yourself a salary of 100,000 and you still want to put another 24 away. Maybe give yourself a salary of 124,000, right? And then 24,000 of that goes to your 401, and then you're left with taxable portion of the income of 1,000. And then also the beautiful thing with the solo 401k is that you can have matching by the employer side, which is also a deduction on the company's income. So if you say that, hey, we're going to match 15% of whatever's put in, and you put in your 24,000, you can still throw in another 3,600, and then that can be also a deduction for your business income while increasing your retirement account. So it's a good way to build a retirement nest. So yeah, that's the main overview of getting yourself set up as a locum tenens practitioner, doctor, or other healthcare professional. This is just a brief overview. If you have more specific questions, feel free to reach out. I'm happy to help, but this should be a good primer to get you going, especially if this is something that's new to you. So that's all for now, and I hope that this was helpful. So if you have any more questions about this topic or any other tax or account related questions, feel free to reach out. I'm happy to help. That's all for now, and I'll talk to you in the next one.